Hi everyone, welcome back to Corporate Decoder, where we try to figure out if your favorite companies are secretly planning a giant office party or just really good at hiding terrible accounting. Today we're diving into Church and Dwight, the folks behind Arm & Hammer and other household names. They've just dropped a new report and it looks like they're shaking things up in their financial department. Let's see what they've been up to behind the scenes. And if you like it when we decode these corporate filings for you, make sure you're subscribed. We also have a super active Discord community linked in the description below. Alright, Church and Dwight, ticker symbol CHD is telling us about some big moves they've made. The real headline here is about their borrowing and credit situation. They've essentially taken out a brand new, much larger loan, and in doing so they've finished off their old one. Think of it like trading in an old car for a shiny new model, but with much, much bigger numbers. This filing is all about a new credit agreement they signed back in mid-July of 2025. This agreement is a big deal because it sets the stage for how the company can borrow money. It replaces an older agreement from 2022 that allowed them to borrow up to $1.5 billion. Now this new deal, it's for a whopping $2 billion. And they can even push that up to $275 billion if they need to. That's a significant increase, almost 33% more borrowing power at the start. This usually means the company has big plans, whether it's for acquisitions, expanding their operations, or perhaps just having a bigger cushion for everyday business. This new credit line is set to last for 5 years, maturing in July of 2030. That's a pretty standard term for this kind of financing, giving them ample time to use the funds and manage their debt. Now, let's talk about how they'll pay for this. The interest rates are tied to what's called a benchmark rate or a base rate, plus something called an applicable margin. Don't let the fancy words scare you. The benchmark rate is basically a standard interest rate that goes up and down based on market conditions, like the SOFR rate for dollar loans or other rates for different currencies. The base rate is more like a bank's preferred rate. The applicable margin is an extra percentage they pay on top of that benchmark rate. This extra margin, the part that's specific to Church and Dwight, changes depending on their credit rating. If their credit rating is good, meaning they're seen as a reliable borrower, this extra percentage will be lower, ranging from 0.625% to 1.125%. If their rating dips, this percentage could go up. This is a common way for banks to reward companies that manage their finances well. Beyond the interest on money they actually borrow, they also have to pay a commitment fee. This is a fee they pay just for having this credit line available, even if they don't use it all. It's like paying for a reservation. This fee also depends on their credit rating, ranging from the bank for certain transactions. Now, every big loan agreement comes with rules called covenants. Church and Dwight has to follow these. These include things like restrictions on who they can take out other loans with, how they can sell off parts of their business, and how they manage their assets. These are pretty standard to make sure the company doesn't take on too much risk that could prevent them from repaying the loan. The most important rule here is a financial one. They must maintain something called an interest coverage ratio of at least 3.75 to 1. What does that mean in plain English? It means for every dollar they spend on interest payments, they need to have generated at least 3,075 in earnings before certain expenses like interest, taxes, depreciation, and amortization. This ratio shows if the company is generating enough profit to comfortably cover its interest costs. A ratio of 3.75 is pretty healthy, suggesting they have a good buffer. Of course, there are also events of default. These are things that could trigger the lender to demand immediate repayment of the loan. Things like missing loan payments, breaking the rules we just talked about, or if the company runs into significant financial trouble, like going bankrupt. They also have to watch out for things like major lawsuits or significant changes in their business that the lender might not like. It's also worth noting that the banks involved in this deal are also customers or service providers for Church and Dwight in other areas. This is super common in corporate finance. It means these banks have a vested interest in Church and Dwight's success, not just because of this loan, but also for their other banking business. And as we mentioned earlier, this new deal meant saying goodbye to their old loan. So officially on July 17, 2025, they shut down their previous $1.5 billion credit facility from 2022. They made sure to pay off any money they still owed on that old loan when they closed it out. This is a clean break, ensuring they transition all their borrowing needs to the new, larger facility. This last part is just a formal way of saying that the big news about the new loan we just discussed is also the reason for this section of the report. It's all connected. Finally, the report includes something called a cover page interactive data file. This is basically a way to make the key information in the report easily searchable and digestible for computers and automated systems. It's part of the SEC's move towards more digital and accessible filings. So what does all this mean for Church and Dwight? Well, they significantly increased their access to capital. This is a strong signal that the company is looking to grow. They're either planning some major investments, perhaps looking to acquire other brands to add to their portfolio like Arm & Hammer, OxyClean and many others, or they're anticipating a period of increased spending on their existing brands. The fact that they're also maintaining a healthy interest coverage ratio and have a good credit rating suggests that they are doing this in a financially responsible way. They're not just borrowing, they're borrowing with a plan and with the financial strength to back it up. The increased borrowing capacity gives them flexibility to navigate future opportunities or challenges. Overall, Church & Dwight seems to be in a solid position, leveraging its strong brand recognition and financial health to secure more resources for future growth. It's a move that signals confidence in their business strategy and their ability to manage increased debt effectively. Alright, that's our breakdown of Church & Dwight's latest filing. What are your thoughts on this increased borrowing? Do you think they'll use it for big acquisitions or just beef up their existing operations? Let us know in the comments below. If you found this deep dive helpful, please give us a thumbs up and make sure you're subscribed for more decoding of your favorite companies. And don't forget to join our Discord community. The link is in the description. Thanks for watching and we'll see you on the next one.